gain. So this question has given us a summary of the transactions for Star, an accounting company, for its first month of operations. And the first part asks us to describe each transaction. So in a lot of questions we've done already, we've given the sentence description in English and we've translated it into accounting speak, or the numbers and accounts. This one is giving us the numbers and accounts and asking us to translate it back into English. So transaction 1 has cash of $18,000, equipment of 6, and Star capital of 24. So what this is saying, as this is the first months of operation, is the owners invested $18,000 in cash, $6,000 in equipment to the business, which increases their initial investment in the business by 24. So that is the initial investment into the business. Transaction 2, minus $4,000 cash, plus $8,000 in equipment, and plus $4,000 in accounts payable. So what this is saying is the company purchased $8,000 of equipment by paying cash of $4,000, as cash decreased by $4,000, and the remaining $4,000 is owed, so a balance on account. So they've basically bought and paid for $4,000 worth of the equipment, and $4,000 they still owe for accounts payable. Transaction 3 says minus $750 in cash and an increase of $750 in insurance. So basically they've prepaid insurance for a time. So it doesn't tell us what the time is, if it was for a year or a few months, but they've basically bought insurance and paid cash for it. So our prepaid insurance, we've prepaid it for the time it's running, and we've reduced our cash by $750. Transaction 4 gives us an increase of cash of $3,500, an increase of accounts receivable of $48, and revenues of $8,300. So this would be that the company has earned interest revenue of $8,300. So they've performed services worth $8,300. And so what they've done is the customer has paid $3,500 in cash and still $4,800 still for the services we provided for $8,300, and we received cash of $35,000. Transaction number 5. Our cash has decreased by $2,000 and our accounts payable has decreased by $2,000. What that tells us is we paid back some of the accounts payable we owed. So we paid $2,000 of the $2,000 we owed. Transaction 6. Our cash has decreased by $3,300, as has our drawing. So what that tells us is the owner has withdrawn $3,300 for personal use. So we've removed it from the company and out of withdrawals or drawings, depending, you can call it either. So basically we keep our personal transactions and the business transactions separate. So they've withdrawn cash for personal use, so we have to remove it from the company's books by taking it out of cash, and we record it as withdrawals, which decreases our owner's equity. They've removed some of their initial capital. All right, transaction 7, we have a decrease of cash of $800, and we have a decrease of our expense, rent. So they've paid their rent expense. So we increase our expenses, which decrease our owner's equity, and we decrease our cash by minus $800. So we've paid $800 for rent expense for the month. Transaction 8, we have an increase in cash of $1,350 and a decrease of accounts receivable for $1,350. So we would have collected $1,350 from our customers who had accounts receivable. So they owed us $1,350. They've now paid us, so we increase the cash, but accounts receivable decreases because they no longer owe us this money. All right, transaction 9. Our cash decreases by $2,700 and our salaries decrease. Okay, so we must have paid salaries. So cash is decreased, we pay our employees, and we record a salaries expense in our owner's equity. So that reduces our profit. And finally, transaction 10, we have accounts payable increased by 420, and we have 420 decrease of owner's equity through expenses. So this says utilities, so we must have received an invoice for utilities expense of 420 for the month of July, and then we owe that money. So we haven't yet paid them, so that means we still owe the money. That's a positive increase in what we owe minus our expense. So that's still on the same side of the accounting equation. One increases, one decreases. Part 2 of the question asks us to calculate profit for the month. And profit is our revenue, what we've earned, less the expenses, the costs incurred to create or generate that revenue. So we pull it from our tabular chart. We had revenue of $8,300 coming from transaction number 4, and then we subtract our expenses. So our rent expense was $800, our salaries expense was $2,700, and our utilities expense was $420. So revenue less expenses gives us our profit. So this company, Star & Co.'s profit for the month of July was $4,380, so $4,380. It then asks us to calculate the increase of owner's equity for the month. So owner's equity is calculated by going our initial investment plus profit minus losses if we had more expenses than revenue, less any withdrawals or drawings the owner takes out of the business. So in July, the owner invested $24,000 in cash. We had profit that we just calculated of $4,380, and the owner withdrew $3,300 in withdrawals or drawings, which means our owner's equity in the month increased by $25,080.